Hi everybody, Thomas Moore here. Today I want to talk to you about one of the most proven investing methods in the history of the stock market, value investing. Now, the principles of value investing have been used for nearly 100 years. While they're not rocket science, the truth is that the principles of value investing remain a mystery to the average investor. Today I'm going to show you 3 of the tricks that I've learned through my own study and experience and that I apply in my value investing methods. Who am I? I've been investing in the stock market for most of my adult life. I survived the dot-com crash of the 2000s, the Great Recession of 2008, and the pandemic-driven crash of 2020. I published what I learned over those years in my book, A Trade for All Seasons, and I've taught thousands of people how to use the same tricks I'm about to talk about. Now, some of the most famous and successful investors in the history of the markets are people like Benjamin Graham, Warren Buffett, William O'Neill, and Peter Lynch. The method that links all of these people together is the value-driven approach that they took, which can be summed up really nicely by one of Mr. Buffett's most widely quoted investing rules. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This rule implies that if you can find stocks with strong proven track records of business success, Buffett's wonderful companies, you'll do more to shift the odds in your favor by working with them than with companies with poor business performance. It also suggests that while your purchase price is an important element of your investing decision, it isn't likely to be the biggest factor in whether you win or lose. If the stock is at, near to, or even below its fair price, you stand a good chance of making money with that stock. The challenge for most investors is identifying stocks that offer the kinds of useful value opportunities that drive long-term investing success. You can spend a lot of time scouring the market, diving into earnings announcements and publications, analyst reports, and opinions on the companies that you're familiar with. The good news is that it's really not as difficult as most people think. The first trick that I've learned to emphasize is looking for stocks in downward trends. Trick number 1 is based on a philosophy called contrarian investing. It follows a simple but generally ignored logic. All market trends eventually end and then reverse in the opposite direction. That means that the longer and further a stock goes up, the more likely it is to reverse and go back down. In the same way, the longer a stock goes down, the more likely it is to reverse and start to go higher. Now that sounds very simple, but the fact is that the tendency to look for winners now makes it actually very counterintuitive for most investors, especially if you're just getting started in the markets. The reason I'm listing stocks in downward trends as my first trick isn't just because most people don't focus on these stocks. It's also because if you know how to recognize 2 simple charting patterns that I'm about to show you, you can start to pick up on the clues that a stock often gives that it could be poised for a solid new bullish pattern. Let's take a look. The first pattern that I like to focus on is called a bullish level 1 setup. This pattern is defined by a few specific characteristics that you'll notice on a stock chart. If you're familiar with some of the basics of stock charts, and you're also familiar with moving averages. Moving averages make up 2 of the primary characteristics that I like to focus on. We're looking at a weekly chart of 3M. That means that each of the price ticks that we see, or candlesticks, represent a 1-week period of time. The moving averages that I have on this chart represent 20 weeks and 200 weeks of time. The 20-week moving average is the green line. And with a bullish level 1 pattern, you'll see the stock not only in a multi-year downward trend, but significantly below the 200 period moving average, which I mark with the blue line that we can see on my chart right now. So this downward pattern that we see in the 200-week moving average is very typical. The 20-week moving average will also be going down. It will be significantly below that 200-week moving average along with the price of the stock. And we can see that in this case with 3M. One of the early indications that the downward trend could be about to reverse comes when this moving average begins to flatten. We start to see the stock begin to consolidate and stabilize off of a recent low. In the case of 3M, we can see that it's rallied off of a low in October at around $85 per share. That, along with the rally over the last few weeks, has led the 200-week moving average to begin to flatten out. So these are the first 2 elements of a good bullish level 1 pattern that we want to look for. Number 1, the declining 200-week moving average. And number two, the flattening 20-week moving average. The third element comes from the stock's price action. As the stock begins to stabilize, you'll start to see different types of candlestick patterns form. One of the most reliable types of patterns that indicate that short-term momentum is beginning to reverse is called a hammer formation. A hammer formation looks exactly like it sounds. You'll see kind of a squared off top on a bullish hammer with an extended line below it called a wick. This is a good example of a bullish hammer. There's also what is considered a bearish hammer, which is the reverse. The wick is at the top of the pattern and the hammer itself is down at the bottom. This can also be filled in or it can be open in both cases. Despite their names, bullish or bearish, the formation of a hammer down at the bottoms of these trends is usually a very good indication that a near-term reversal is about to happen. For 3M, this happened last week, in fact, with this candlestick right here. It looks something like this. When this kind of hammer formation appears, as it did last week for 3M, you have a good signal to go ahead and look for an opportunity to place a trade. So this is exactly the kind of signal that I like to look for the trades that I place with my Rebel income system. The second type of pattern that I focus on is called a bullish level 2 setup. Now, just like a bullish level 1 pattern, with bullish level 2, you're still going to be looking at stocks that have been following extended downward trends. The difference lies in where the stock price is in relation to its major moving averages. Again, the 200-week and the 20-week moving average. I've switched the view on my chart to a look at mosaic. We can see that in this case, the 200-week moving average has been going up for the last year or so, but is following a very gradual slope. That's a very good first indication of what we want to see with a bullish level 2 under ideal circumstances. The 20-week moving average will still have been going down, but instead of sitting significantly below the 200-week moving average, what you will see is that it will begin to approach the 20-week moving average, and when it begins to flatten out, you'll see the creation of a relatively narrow range between the two moving averages. And that creates the consolidation range that the stock's price action begins to follow. That flattening of the 20-week moving average and that narrowing channel that I'm describing are the second signal that we're looking for with the bullish level 1 pattern. The actual signal to place the trade still comes from price action. And again, we look for exactly the same kind of candlesticks that we do with the bullish level 2. So we're still looking for hammer candlesticks. In this case, beginning 3 weeks ago for MOS, we saw two specific hammer formations. The first one looks something like this, and the second looks something like this. Now we can see that after the appearance of these two hammers, the stock has really started to lift off and begun to see a significant increase in bullish momentum. Bullish level 1 and bullish level 2 then both provide very high probability opportunities that the stock's downward trend is about to reverse and could begin to go up again. And that's why these are the patterns that I like to focus on in my analysis as I'm emphasizing stocks in downward trends. Trick number 2 follows the straightforward principle of comparing a stock's current price to the value of the underlying company's book of business. Now, there are a lot of ways that you can try to identify how much a company's business is worth. You can spend a lot of time reading books favoring different methods. I've learned to borrow from a simple principle Mr. Buffett uses and has written a lot about over the years. Company's book value per share is a simple metric you can find on just about any stock market website for free. Mr. Buffett favors this number, calling it the amount per share that will be left for shareholders if a company closes its doors today, pays off all of its obligations. Under the most ideal circumstances, if a company's book value per share is higher than its stock price, then you found an untapped resource the rest of the market is probably not paying attention to. The only problem with that ideal scenario is that the market typically prices stocks at a multiple of the underlying company's book value per share. That's why I've learned to compare a stock's current price to book ratio, whatever it is right now, to its historical levels. If a stock's current price to book ratio is below its historical average, I'm on my way to finding a good value candidate. Another useful way that you can identify the value of a company's business is in cash flow analysis. Cash flow in basic terms is the cash that is left over every quarter or year after all expenditures, capital expenses, debt service, etc. have been paid. Like book value, this metric is easily available, and so is a stock's price to cash flow ratio. In my Rebel income investing system, I combine historical analysis of both ratios to their current levels to find the price that I believe represents a company's fair value price. I also emphasize stocks that offer discounts of 12 to 20% or more below their historical levels. Trick number 3 is to look for fundamental strength. Now, no matter how good a stock's value opportunity may appear, I've learned to emphasize a few very specific elements of a company's underlying fundamental strength to identify the companies that best fit my Rebel income investing system. First one is free cash flow. Free cash flow gives you a way to see how much money a company has left to work with after it's paid its capital expenses. Capital expenses are the basic items required to keep a business running: facilities, labor costs, and so on. Think of a company's cash flow as a way to check to see whether the earnings figures you've already looked at pass muster. The company's balance sheet is another important source of information, since it provides a look at the company's latest cash and liquid assets, along with the amount of long-term debt they carry. These provide perspective about a company's ability to invest in its business, pay its obligations, and its ability to return value to shareholders. Net income is a useful metric to see what is left from revenues over a period of time after all expenses have been paid. Along with free cash flow, it provides a useful perspective about whether operating margins are stable, increasing, or decreasing over time. The final piece that I like to focus on is dividends. Dividends are a critical piece of my investing system. Only a fraction of stocks that make up the U.S. stock market pay a consistent dividend, which makes them a natural way to filter through the tens of thousands of available stocks. Dividends also have to be approved by a company's board of directors and paid from either cash flow or available cash, which makes them an even more useful metric of fundamental strength. Now, I said earlier that you can spend a lot of time analyzing stocks throughout the market to identify value opportunities on your own, and that's true. Even if you apply the 3 tricks that I've shown you, doing it day after day on stock after stock can take more time than you probably have. That's one of the reasons I've built my Rebel income system of analysis, so I can point you to stocks that I think offer useful value under current market conditions. I publish my analysis of a lot of the most recognizable names in the stock market for free on this channel, so you can get a quick look at stocks you should pay attention to, as well as stocks that just aren't worth your time right now. I also make my trades available to my clients every week, giving them opportunities to leverage the principles of value investing that I've outlined under any market condition. If you like what you've seen, you can subscribe to my channel here to get alerts for every new video that I publish. You can click here to learn more about the complete Rebel income system that I use. If you'd like to subscribe to my trading alerts, you can click on the link shown down in the description for this video. Thanks for your time, everybody. I'm Thomas with Rebel Income. Talk to you again soon.